They won't teach you this in school because it keeps you broke. But these 7 tax tricks, they're the wealthy's best-kept secrets. Number 1. Real estate depreciation, one of the richest tax loopholes? Here's how it works. Let's say a wealthy individual buys a real estate property. Even if that property's market value increases over time, the IRS allows the property owner to deduct depreciation on the property's value every year. This is based on the idea that the property, like a car or equipment, loses value over time due to wear and tear. The trick here, even if the property's value appreciates, the tax deduction doesn't change. So while the property increases in value, the owner is deducting a portion of its value each year from their taxes. This non-cash deduction helps wealthy individuals reduce their taxable income significantly without losing money on the property. Number 2. Capital gains tax rates. When wealthy people invest, they don't just throw their money into anything. They focus on assets that will appreciate over time, like stocks or real estate. But here's the kicker. When they hold these assets for more than a year, they qualify for long-term capital gains tax rates, which are significantly lower than ordinary income tax rates. For instance, while the ordinary income tax rate can be as high as 37%, long-term capital gains tax rates are only 15% to 20%. This allows the rich to pay less tax on profits from investments. They're literally paying less tax on their gains than someone earning a regular salary. Number 3. Tax loss harvesting. But what happens if one of those investments loses money? No problem. The rich use a strategy called tax loss harvesting to minimize their taxable income. Here's how it works. When an investment decreases in value, they can sell it off and realize the loss. That loss can be used to offset the gains from other investments. So let's say they made a profit on one investment but lost money on another. By selling the losing investment, they reduce their taxable gains and therefore their overall tax bill. Number 4. Retirement account contributions. Another classic strategy, maximizing contributions to retirement accounts like 401ks or IRAs. When the wealthy contribute to these accounts, they're able to defer taxes on that income until they withdraw it in retirement. Why does this matter? Because they're lowering their taxable income today, which means paying less in taxes right now. Plus, these accounts grow tax-deferred, meaning they can accumulate wealth without being taxed along the way. Later, when they withdraw funds, they might even be in a lower tax bracket, so they end up paying even less tax on the money they take out. Number 5. Charitable donations. The rich are also known for their generosity, but it's not just about helping others. Charitable donations come with serious tax benefits. By donating to causes they care about, wealthy individuals can deduct those donations from their taxes. But here's the kicker. If they donate appreciated assets like stocks, they can avoid paying capital gains tax on the appreciated value. So for example, if they bought stock for $10,000 and it's now worth $50,000, they can donate the $50,000 and avoid paying the capital gains tax they would owe if they sold the asset. Not only does this reduce their taxes, but it also allows them to support their chosen causes in a meaningful way. Number 6. Life insurance policies. You might think of life insurance as something you only get for your family's security, but the wealthy also use it as a wealth-building tool. Certain life insurance policies, like whole life insurance, accumulate cash value that grows tax-deferred over time. What does this mean for the wealthy? They can borrow against this cash value without triggering any taxable events. So, essentially, they have a source of funds they can access without increasing their taxable income. And when they pass away, the policy's death benefit is typically tax-free for their heirs. This strategy provides a tax-efficient way to create wealth for future generations. Number 7. Finally, we have the infamous buy, borrow, die strategy. This is how it works. The wealthy accumulate appreciating assets, like real estate, stocks, or businesses, over time. When they need money, they borrow against those assets. Why borrow instead of sell? Because loan proceeds are not taxable. So, they get the cash they need without trigger. It allows the rich to live off their assets without selling them, and then pass them on to the next generation with minimal tax consequences. With the right knowledge and planning, you too can optimize your taxes. Want to dive deeper into each loophole? Subscribe and stay tuned for our upcoming videos where we break down each tactic step by step.